everyone, and welcome to another episode of Property Q&A. I've not been able to do this for a few weeks now because I have just been so busy and I've literally been inundated with questions. They've been building up. I've just literally got a stack of them here. I have replied to a few of you by email. However, there are a few questions that are very similar and I thought I'd leave those and respond to them in a video. The first question, I've had similar questions from quite a few people. This one in particular came from Richard Cannon from Milton Keynes, and he asked, we are thinking to move up and take advantage of low interest rates, but we are worried in case there is a crash or if interest rates rise. What are your thoughts? Well, Richard, two separate factors. Both can often be connected. With regards to property crashing, there are people on YouTube who seem to make a career out of prophesizing another property crash. There are always blips up and down, whether they are daily, weekly, monthly, seasonal, but an actual sort of crash, a drop, like we had in 2008 or when we had in the time of the Black Wednesday, that I do not expect to happen. First of all, let me explain the financial reasons why it won't happen. Anybody who remembers, prior to the 8th of October 2008, the base rate was 5%. And in the preceding decade or two, it had been sort of below 10%. However, for the preceding 2-3 decades, the standard variable rate on mortgages was normally within 1% of the base rate. In fact, prior to then, fixed rates were often more than the standard variable rate, which is different to now. So if we say that the average standard variable rate prior to October the 8th, 2008, when they began to drop, used to be within 1% of the base rate. So from the point of view of the banks, their markup on the base rate was between 10 and 20%. Now, following the world financial crisis, our interest rates started to drop. They went down 5 times, I think, and by March 2009 they settled at 0.5%. However, the standard variable rate on most mortgages remained the same. Even to this day, it hovers around 4.5% to 5%. So what does that mean for you, and what does that mean for the banks? It means for you and most lenders as a whole, those on a standard variable rate have not really seen a great benefit as a result of these momentous drops in interest rate. But for the banks, it has meant a massive increase in profits. And just to put it into perspective, let me break it down for you. As I said already, prior to 2008, if the base rate were 5%, and they lent out of their variable rate was say 6%, that is a markup of 20%. Today the base rate is 0.1%, and there are still many lenders asking 5% or more on their standard variable rate. That, my friends, is a markup of 5,000%. The banks are literally swimming in money. They cannot give it away. And despite short-term changes, because of the current COVID crisis, maybe valuers can't actually get into a property and they have to do a desktop valuation. So when there's a tightening of the measures, the banks withdraw the high loan-to-value products because the valuers can't get into the properties, so they have to allow themselves a larger margin. But since 2008 to this day, the banks have been raking in a fortune. And when the banks are awash with money, there will be no end to their capacity to lend. So we will not have the same banking-led crash that we had before. We can have seasonal and we can have political factors that can affect the market. It spent a great period blipping up and down due to the uncertainty of Brexit last year, the elections, now COVID, etc., etc. But they are not chronic threats. They are just short-term blips. So I doubt very much that there will be any form of significant crash in property. It will invariably slow down when the stamp duty holiday ends. That's provided that they don't extend it. I would have liked to have seen them taper it off over 6 months to avoid this rush that is putting everybody under pressure. But who knows what they will do. Now, the second part of your question, interest rates rising. Once again, for the reasons that I've already stated, banks would not want to see interest rates rising because they need to get rid of their money. So from that point of view, there isn't pressure on interest rates in an upward manner. We have no imminent risks of higher inflation, so there isn't pressure on the Bank of England to force the base rate up for those reasons. And regardless of which side of the fence you may sit on with our impending departure from Europe, I think that my feeling is that that will actually contribute to keeping inflation down, not increasing it, because, as will be revealed, there will be many products that we were restricted with before that we will now be able to import from other countries based on our individual deals with them. That's the way things are at the moment, but who knows with the people upstairs what deals they make behind closed doors. So, there is one further factor. After the crash of 2008, the government encouraged foreign investment in London at the high end to actually help get the economy going. Prior to this last property boom, if we're going to call it that, most property price rises were from the bottom up. So it began with an influx of first-time buyers, pushing things up through to the semis, the detached houses, and so on and so on and so on. This time round, it wasn't a bottom-up boom, it was a top-down boom, because money flooded into London from foreign investors into these expensive developments in the Docklands and wherever, and that literally raised the bar on those properties, and it filtered downwards, and they literally pulled the prices up from the top, working their way downwards. Now that was tempered slightly with the changes to stamp duty a few years ago, but it's still ticking over fairly well. However, in the immediate short-term future, there is still a lot of money pouring into London to beat the additional 2% stamp duty for overseas investors that will come in April next year. Going back to the fact that we'll be leaving Europe, the fact that we are separate from mainland Europe, that our currency is one of the most respected, most credible currencies and stable currencies in the world, I can see the investment into the UK, which will literally be an island sanctuary come January, to continue, and therefore I do not see any pressure from any direction for either of those two things to happen. However, interest rates and banking is very fluid. Things can sometimes change overnight, but our mainstream banks do not, to my knowledge, have any high risk exposure that would risk the same thing as last time happening for the main part. So I really wouldn't worry. However, one final point to note. Don't base your affordability on a property on the deal that you will get at a fixed rate. Base your affordability on the standard variable rate. Most people go for a fixed deal for 1 or 2 years, 3 at the most. Not many go for 5 years or 10 years. That 1 or 2 years goes by very quickly. You may think to yourself, no problem, I'll just refix. That's fine. However, any change in your circumstances in the meantime, business has been affected by COVID, you've been furloughed, your employment contract has changed, whatever the case may be, even though you may be very well behaved fiscally and your credit file may be in perfect order, any of those changes, as some of the people who have been furloughed have found to their cost, could affect your ability to refix your mortgage. And if you base your financing and your budget on paying 1.5% interest or 2 or 1%, whatever it may be, and it suddenly reverts to 5% because you are unable to refix, you need to be certain, can you afford that? Provided you budget for that so that you are covered for every eventuality, I see no problem for you to actually move upwards and take advantage of the process that most of us go through by moving up through property throughout this country. I'll be back on the next video with a few more questions. I'll only do 1 question per video so they don't go too long, because otherwise I'll waffle on for ages and you'll all get fed up with me. So I'll be back soon and I'll see you in the next video.